Investment properties, IPSAS 16. Now we will cover IPSAS 16 investment properties. Basically, it depends upon IAS 40, International Accounting Standards 40. If you are familiar with IAS 14, then IPSAS 16 is very easy for you. First of all, we study there's definitions. According to IPSAS, it is very important that you know the definitions of an investment property for your exams. Exams mean your diploma exams or any other exams. Similar to that, basically in this IPSAS, the key point is to differentiate between the investment properties and owner-occupied properties. If you are able to differentiate between these two definitions, this lead towards the finalizations of your cover to this IPSAS 16s. Investment properties, basically investment properties is property, land or a buildings or a part of a buildings or both that held to earn rentals or for capital appreciations or both rather than for use in productions or supply of goods or services or for administration purpose. The property which are used in productions are not investment properties. The property which are used in supply of goods are not investment properties. The property which are used in providing services or for any other administrative purpose are not investment properties. Investment properties are only those properties which are held to rent, earn rent or for capital appreciations or both. And the sale in ordinary course of operation is also not a part of investment properties. Now we are able to identify the definitions of investment property. Now we will move further. Owner occupied properties. What is owner occupied property? Property held by the owner or by the lessee under finance lease or for use in productions or supply of goods or services or for administrative purpose. The points which were not are the part of investment properties are basically the part of the definition of owner occupied properties. Some examples of investment properties, as we discussed above, that the investment properties is for earning rent or capital appreciations or both. So here are the examples highlighted in yellow colors. Land held by hospital for capital appreciations which may be sold at a beneficial time in the futures. Similarly, property that is leased out to external parties under operating leases on commercial basis. Basically, in operating lease, ownership remains in the same owners. Therefore, it may be rented out or leased out on commercial basis. So now the lease to external parties under operating lease on commercial basis is examples of investment properties. Now move to another examples. An official building which is currently vacant but is held to be leased out under one or more operating lease on commercial basis to external parties. So basically this is for earning rent. An investment property is not any of the following: a building used in the productions or supply of goods and services, held for resale in the ordinary course of business. Example, public sector organization that build and sell affordable housings, which would be covered by IPSAS 12 inventories, as we discussed in early chapters. Being constructed for future use by a third party, which would also be covered by IPSAS 11 construction contract, which is also not example of investment properties. Another which is also not example of investment property is property leased to another entity under a finance lease. Basically, in finance lease, the ownerships transferred to the other persons. So basically, it is not for capital appreciations or also not a part of for earning rent. So it is not example of investment properties. Another examples which is not a example of investment properties, property which is primarily held to provide social services. So social services is not a part of uh, investment properties. Now we move towards exercise. Identify investment properties. Are the following asset investment properties under IPSAS 16 definitions? A government owns a hostel that it manages through its general property management agency. The ancillary service provided to residents in the hostels are significant to arrangement as a whole. Basically, this point discusses the supply of services. As we know that supply of service is not a part of investment properties. It is basically owner occupied properties. The second part of a question is hospitals owns a buildings, part of which is used for administrations and part is leased out as apartment on commercial basis. One portion is for administrations and one is for commercial basis. The commercial go to investment properties and administration go to owner occupied property. So if part could be sold or leased out on finance lease accounts separately, that part is investment property. If not, then the whole is owner occupied properties. Now the question is how we treat in financial reporting. Accounting treatment for investment properties. Initial recognitions. Same as for property, plant, equipment, as we discussed in earlier chapter, IPSAS 17's property, plant, equipment, PPE. The initial recognitions of investment properties is same. The basic two criteria are also same. The number one, it is probable that future economic benefit or service potentials that are associated with the investment properties will flow to the entity. And second, the cost or fair value measure reliability. Investment properties are initially recognitions measured at cost. If the investment properties has not been acquired through an ordinary acquisition, then the property is measured at fair values, similar to PPE IPSAS 17's. Subsequent measurements. How to measure the investment properties in the subsequent years? You may be recognized by one of two methods: cost model or fair value method. Cost model is similar to as you discussed in initial recognition, and fair value models to measure the investment properties in the subsequent years on market value basis. The important point and the very important point in IPSAS 16, the same model must be applied to all of an organization investment properties. If an organization uses the fair value models on one of its investment properties, then it is mandatory that it should be used the fair value models on the second investment properties. Now the exercise 3.14, accounting for investment properties. For the following organization, identify the accounting entries that would be required at the year end to report the investment properties in accordance with IPSAS 16. Organization A uses the fair value model to account for its investment properties. Organization A owns an investment property which is currently held in their account at fair value of 1 million. At the end of the year, the fair value of the property is 1.1 million. The question is how to measure the value of property, investment properties in the subsequent years, in the second years, at the end of years. Oh, it is very easy. Had it used fair value models, now it should be used the fair value of investment properties at 1.1 million. The increase from 1 million to 1.1 million goes to statement of financial positions, debit investment properties 0.1 millions, and credit other income 0.1 millions. So you see the difference of 0.1 millions. This is basically due to fair value models. The value of investment properties in market at current is 1.1 million, the increase of 0.1 millions. So we should record the value of investment properties at 1.1 million, not at 1 millions. Part B of question: at the end of the following accounting period, the fair value of organization A's properties was 0.9 millions. The difference of 0.2 millions, 0.2 million goes to expense 2 million, 0.2 millions, and it should be credited to investment properties against the value of 0.2 millions, goes to statement of financial positions. Part C of the same question. Organization B uses the cost model to account for investment properties. At the end of the previous reporting period, the properties had a carrying value of 1 million. The company charged depreciations on investment properties using 20% reducing balance. The fair value of the properties at the end of the current period is 1.1 millions. Now we use cost models. We have no concern with fair value 1.1 million because we use cost model. So we just apply 20% depreciations on 1 millions, that is 0.2 millions, that go to expense statement of financial performance, and 0.2 millions credit to accumulated depreciations, that goes to statement of financial positions. Now we move the next part of the IPSAS 16, transfers and derecognitions. How we treat the transfer of investment property, how we derecognize the investment properties from our financial reportings. An entity may change the uses of its assets. A change in use occurs when the properties meets or ceases to meet the definition of investment properties, and there is evidence of the change in use. Intentions for the use of a property does not provide evidence of a change in use. Examples, see the part B. Commencements of development with a view to sale for a transfer from investment properties to inventories. The management involves decided to sell the properties for a transfer from investment properties to inventories. The property that is ready to sell shift to inventories. IPSAS 16 provides guidance on measuring the assets at the point it is transferred. Derecognitions of investment properties is accounting for in the same way as derecognitions of property, plant, and equipments. So here, as we discussed earlier, in IPSAS 17 PP, the same methods applies here. On derecognitions, if there is a gain, the gain should be treated at income in financial performance. And on derecognitions, the investment properties further no more in the financial positions. Here are the disclosure requirements. The end of this IPSAS. An entity must disclose the following in relation to investment properties: whether it applies the fair value or the cost model. It should be described in disclosures, which is very important. Here are the other disclosures. For example, if it applies the fair value models, whether and in what circumstances property interest held under operating lease are classified and accounting for an investment properties. It should be described. It should be disclosed. When classification is difficult, the criteria it used to distinguish investment properties from owner-occupied properties and from property held for sales in the ordinary course of operations. Basically, in these disclosures, you need to discuss the basis on which you distinguish the investment properties, owner-occupied properties, the criteria, the methods and significant assumptions applied in determining the fair value of investment properties, including a statement where the determinations of fair value are supported by market evidence. So you have to discuss the assumptions in market on which you have to decide fair value. Here are many other recognition and disclosure notes. For example, F, the amount recognized in surplus or deficits, rental revenue from investment properties, surplus or deficits. You need to disclose it. Direct operating expenses arising from investment properties that generated rental revenue during the periods. Now, you need to disclose the direct operating expense related to generate the revenue from investment properties. Similar direct operating expenses including repair and maintenance arising from investment property that did not generate rental revenue during the periods. Basically, these are useful and these are expenses that are not give returns to you. The existence and amount of restrictions on the realizability of investment properties or the remittance of revenue and proceed of disposals. Similarly, contractual obligations to purchase, construct or develop investment properties or for repairs, maintenance and enhancements, you need to disclose it. Further disclosure requirement for properties held under fair value models. Here is important point. The disclosure notes we discuss from here A, B, C, D, E, F, G, H. These are the important disclosure notes, and the further disclosures are less important. If you have option to choose the disclosure notes from both, you should opt it from the main disclosure notes. Further disclosure requirement for properties held under fair value models. So you should disclose the additions, disposals, net gain or losses from fair value adjustment, transfer to from inventories and owner occupied properties. And if you use cost models, you should disclose the depreciation methods used, whether it is straight lines or reducing balance or any percentage. The useful lives or the depreciation rate used, whether depreciations at 20%, 10%, it should be disclosed. The useful life, the life of assets, whether it is 10 years, 20 years or any else. The gross carrying amount and the accumulated depreciations at the beginning and the at end of the periods. Similar reconciliations of carrying amounts be disclosed. The fair value of investment property is the important point that you are using disclosure, you are discussing the disclosure notes under cost models, but IPSAS asks you to disclose the fair value of investment properties. It is useful for the user to analyze from both angles. Here is the end of IPSAS 16's investment properties. In the first part, we discuss the definitions, and we see that IPSAS 16 based upon the IAS 14 After definitions of investment properties, owner-occupied properties, we discuss the examples of investment properties, and further we discuss the examples which are not investment properties, and we solved exercise, and further we discuss the accounting treatment of investment properties, initial recognitions and subsequent measurement, and we further discussed the example 3.14 accounting for investment properties. After that, transfer and derecognitions of investment properties were discussed. And further, in the end of this IPSAS 16, disclosure requirement of these standards were discussed in details. Thank you.